Let's take a look at exercise 11-18, which is an asset impairment problem. I'll read it to you. You see the information on the top of your screen. The management of Sprague, Inc. was discussing whether certain equipment should be written off as a charge to current operations because of obsolescence. The equipment has a cost of $900,000 with depreciation to date of $400,000 as of December 31st, 2010. On December 31st, 2010, management projected its future net cash flows from this equipment to be $300,000 and its fair value to be $280,000. The company intends to use the equipment in the future. Okay, now the instructions for Part A says, prepare the journal entry, if any, to record the impairment at December 31st. So let's take a look at that. I'll slide this off to the side, and we see the solution. We're going to record a $220,000 loss on impairment. We debit loss on impairment for $220,000, and we credit accumulated depreciation on the equipment. Now, we notice that the asset fails the recovery test. How did we come up with this? Well, we compared a $300,000 value to $500,000, the current book value. So, cost is $900,000. Accumulated depreciation was $400,000, just to the left of my mouse here. So we had a book value or carrying value of $500,000, and management says the fair value of the fair value of the future net cash flows from the equipment is $280,000. So we've got a $220,000 loss. But the projected future cash flows of the equipment was $300,000. So when we compare the $300,000 to the book value, we know that we then need to consider the $220,000 as the loss on impairment. And that takes care of Part A. Okay, then we look at Part B in the instructions. Where should the gain or loss, if any, on the write-down be reported on the income statement? And I'll slide the image that's hiding the solution off to the side. And what we see is it may be reported in the Other Expenses and Losses section, or it may be highlighted as an unusual item in a separate section. But it is not reported as an extraordinary item. Okay, moving on to Part C and D. C says at December 31st, the equipment's, this is of the next year, 2011, the equipment's fair value increased to $300,000. Prepare a journal entry, if any, to record the increase in the fair value. And D says, what accounting issue did management face in accounting for this impairment? All right, so let's slide the blue screen away, and what we see is no entry is necessary. There's no restoration of any impairment loss. So we would not restore the value. The lower value becomes its permanent value. D says, or the answer to D, which was what was the management issue? Management first had to determine whether there was an impairment. To evaluate that step, they embark on a recovery test. The recovery test estimates the future cash flows expected from use of the asset and its eventual disposition. If the sum of the expected future net cash flows, that means undiscounted now, is less than the carrying amount of the asset, then we know there's an impairment. If the recoverability test indicates that an impairment has occurred, then we compute the loss. The impairment loss is the amount by which the carrying amount of the asset exceeds its fair value. Okay, and we saw that on Part A. Let me slide Part A over, and you'll see that again. Okay, so here we see the numbers that support our answer in D.